Before, you manage money for a living. Last year, the trades went wrong and you lost 7% of client assets. The quarterly statements are due. The account is short. Seed. You move $22,000 from one client account to cover another. You call it a timing adjustment. You print the statements with the returns you promised. The clients cash their checks and nothing happens. There are no calls, no investigations, no consequences at all. This is called Ponzi fraud, named for Charles Ponzi, who ran the original scheme in 1920. He raised $15 million before it collapsed in 8 months. You have just committed the first act of something that cannot be stopped once it starts. Bloom. Your investors receive their promised returns. They tell their friends, the friends call you, you tell them you are not taking new money. They ask for an exception. You make one because you like them. They feel chosen. They tell their friends. Charles Ponzi never advertised a single day of his operation. His investors were his marketing department, and every word they said was true from where they sat. Word of mouth from satisfied investors is the most effective recruitment tool ever built. The problem is that every new investor is a new name on a list of people you will eventually destroy. Apex, you are a financial legend. You never advertised. You run an invitation-only operation and wealthy investors beg for access. You turn most of them away. The rejection is your best recruitment tool. Prospects feel privileged when you agree to take their money. A feeder fund routes pooled investor capital directly to you. One such fund channels $7.5 billion your way. It earns $100 million per year in fees without ever verifying a single trade. Nobody audits the manager who always beats the market. On the 17th floor of your building, fewer than 24 employees use a computer from 1982. They look up old copies of the Wall Street Journal and backdate trades to match what the market actually did. Your statements go out on paper and by mail because paper leaves no digital trail for investigators to subpoena. You are the broker, the advisor, and the custodian simultaneously, with no independent party to verify anything. That architecture is deliberate. You attend charity dinners tonight and accept applause for donations funded with someone else's retirement savings. Fracture. 1 month, the spreadsheet does not balance. The amount investors want to withdraw is larger than the amount new investors are depositing. The gap is $500,000. You tell one investor their funds are locked in an illiquid position, meaning tied up in a trade that cannot be closed right now. You delay another withdrawal with processing time. Next month, the gap is $1.2 million. The month after, it is $3 million. Bear Stearns fails in March. Lehman Brothers fails in September. By November, you have $105 million in withdrawal requests and $13 million in your Chase account. You still attend dinner parties and perform calm. You have been performing calm for months. Scramble. You are blocking withdrawals. You tell investors their money is locked in positions that do not exist. You are accepting new investors you would have turned away 6 months ago because every new dollar buys another week. You are lying to your employees and to regulators. Every new lie is a new federal criminal charge layered on top of the underlying fraud, though you are thinking in days now, not in legal categories. Each day you survive is another day you tell yourself there is still a way out. You have been telling yourself this for months. The math has known the answer longer than you have. Freefall, December 9th, 2008. You call your sons into the apartment. You tell them the asset management business is a fraud. You tell them it has always been a fraud. You use 4 words. It's all one big lie. There is a strange, brief relief because the secret is finally outside of you. Then your sons leave and call a lawyer. The lawyer calls the FBI. 2 federal agents arrive at 7 the next morning. They ask if there is an innocent explanation. You have nothing to say. You are 70 years old. They take you out of the building in handcuffs. On the 17th floor, the computer from 1982 is still running. The Wall Street Journal archives are still there. 1,500 boxes of documents are still there. Everything you built to keep the lie alive is still there, as if it had always been permanent. Reckoning, June 29th, 2009. The courtroom is packed with the people you stole from. You read a statement. The judge sentences you to 150 years. The room applauds. You are 70 years old. Your name stops being a name and becomes a crime category taught in finance courses for decades. Your son Mark dies on December 11th, 2010, 2 years to the day after your arrest. His infant son is asleep in the next room when it happens. Your son Andrew dies 4 years after that. You will outlive both of them in federal prison. Your grandchildren petition to change their last names. Your wife reports every purchase over $100 to a bankruptcy trustee. Wreckage. In federal prison, you earn $710. You once managed $65 billion in claimed investor assets. 40,930 victims in 127 countries recover 94 cents of every dollar lost. The two men who took their own lives after the collapse are not covered by that number. You pass a young man on the prison work detail carrying a ledger. You remember $22,000 moved between accounts and telling yourself you would fix it before anyone noticed. What you could not see was everyone who trusted you. They were already on a list written with that first transfer. The first lie always costs more than the scheme ever paid out.